Welcome to the Techno Fundamental Report for November 26. Nicholas Darvis, one of the first books I can remember, I went over to Barnes & Noble, and I was sitting there looking for books to read, and I saw this book about Nicholas Darvis, who wrote about how he made $2 million in the stock market in 1956. He says, all a company's reports and balance sheet can tell us what's happened in the past, and the present they cannot tell the future. I was successful in taking larger profits than losses in proportion to the amounts invested. First, check whether the market as a whole is rising or falling. In other words, are you in a bull market or a bear market? If the latter, stay out. The odds are against you. I became overconfident, and that is the most dangerous state of mind anyone can develop in the stock market. I decided never again to risk more money than I could afford to lose without ruining myself. I made my mind to buy high and sell higher, so it's buy high, sell higher. I knew that I had to adopt a cold, unemotional attitude towards stocks, that I must not fall in love with them when they rose. I knew that to do this, I had to achieve something much more difficult than anything else before. I had to bring my emotions, fear, hope, and greed under complete control. I had no doubt that this would require a greater amount of self-discipline. So you ought to read this book. It's a very short book. You can read it in a weekend. It's How I Made $2 Million in the Stock Market by Nicholas Darvis. You know, what we're talking about here is a very small number of opportunities. All you need to do is find one, maybe two. So once you realize this, you start to understand the stock market. It's not a bunch of opportunities out there. It's very limited. It's like a needle in a haystack. You got to find the needle in a haystack. So risk management means you have to keep the losses under control so that when you do find the golden egg, you can benefit. As this study has shown, which I've shared with you for the last 3 weeks, since 1926, only 3.44% of the companies out there have generated the net return. So just wake up and realize that the Walmarts back in the 70s and in the early 80s, I can remember I was the branch manager of Howard Wheel Louise Friedrich's office in Pensacola, Florida. And Hank Corbin, who was a good friend of mine, was a investment banker with Stevens and Company in Little Rock, Arkansas. We happened to be in Pensacola that day and came by my office and said, you ought to take a look at Walmart. Now, this was like 1982. And so the point is that it was a golden egg. And you know what? The bad news for me was I ignored his advice. I didn't take advantage of the situation. But as I've grown older, I know better. So let's talk a little bit price and volume. So there's price, there's volume, and then there's time. And so when you see an opportunity, so we own the stock right here, Eli Lilly. Now you can see where it had a nice quiet period here. It was building a solid base. And then it broke out on exceptional volume, which tells you that institutional investors are coming in. And look at that nice uptrend. Now we own the stock. Don't plan on selling it unless it breaks the uptrend. But with volume, it's an important component. It's price, volume, and time. So once you get the breakout in the price, and then once the stocks proves itself, you take advantage of it. So let's look at what's going on with the volume right now. Excuse me, I'm having a little bit of a cold this week. The NASDAQ continues to struggle. We've been in a downtrend here. We've tried to base lots of volatility, trying to break above that lower moving average, but it's doing it on volume that is not really exceptional. The mid-cap stocks, unbelievably, are leading the way. They're breaking out above the moving averages, looking pretty darn strong. You're getting some good volume in here. So let's look here at the New York Stock Exchange Composite. It too has broken out above the two moving averages. Small caps are looking incredibly strong. This is positive. This is very positive. So you're getting some reasonable volume, and the small caps are breaking out. The S&P 500, same story as the NASDAQ, kind of holding in there, broke above the upper moving average, actually giving some good volume here. This looks somewhat like a follow-through day. Economically speaking, the unemployment index has really reached a higher level than I would like, 4.4%. The aggression index gave a sell signal trying to bounce back, but I would consider this to mean you should consider to continue to be cautious. Interest rates are well under control. The 5-year Treasury yield is at 3.5%, 3.565, and it has been declining for almost 11% for the last 125 days. So interest rate, look, I'm of the opinion that there's only two things you should look at. Don't look at who's president. Don't look at any of this political stuff. Just look at corporate earnings and interest rates. And interest rates are clearly under control here. So we don't want to worry about that. Now the VIX today dramatically dropped. So hopefully that means that we're this bottom is in. Who knows? But the VIX, the volatility index, is improving dramatically. Price of oil, everybody worries about inflation. Well, oil is the best indicator. And you can see here it's in a definite downtrend, closely to making new lows. New lows have been troublesome. They've been very high. But for the first day, and this is as of today, we're starting to see some improvement there, under 40 for the first time. So, be aware, that's a positive. Now, the NVIDIA, there was news today that Google has got a chip that will compete with NVIDIA. So now we have a company who had no competition, now has competition. So you can see here that stock is in a downtrend. I would continue to be cautious on technology. Not because there's not bad things out there, it's just things are changing. So if you have any questions, please let me know. Thank you very much.